Hello, today I want to take another look at a seasonal anomaly or a calendar anomaly. There are other videos in this series. You can watch those videos if you follow these links right here. Now, today, given the fact that this is the last trading day before the 4th of July holiday weekend, we get a 3-day weekend this year. I wanted to see whether or not there is any kind of 4th of July effect. So here is one trading strategy. The idea is you get into the market prior to the 4th of July, and then you exit that market either through a stop loss or by realizing a 1-day profit. Turns out that if you get in 2 days before the 4th, that you end up with a 95% hit rate over these 21 years. And if you get in kind of 1 day before or 3 days before, you still have an 85% chance of making money here. And the profits are pretty reasonable. Seems pretty interesting. Now we can go back and look at even more time than we did into just these 21-year periods of time. So we kind of broke this down into a number of different periods. And we see, yeah, it kind of looks like, 5 days prior to 2 days after the 4th of July, that in general returns are pretty nice. But then if we go kind of 3, 4, 5 days out there, there are some times when we get, pretty negative returns, relatively speaking. Honestly, there's not a ton of statistical significance to this data, but it's some additional food for thought. Another thing we could do is say, hey, let's get in, slightly before a holiday because people are all excited for the holidays and see what happens here. Turns out if you get into the market 1 day before the 4th and then hold it till the end of the year, if you do that on Independence Day, that is the best time, the best holiday to implement that strategy. Now, another thing we should think about, well, maybe there are particular companies out there that do particularly well. So what I want to do here is I want to think about companies that have products that sell really well during particular seasons. And the 4th of July, the summer, is kind of a nice thing to think about because you think about 4th of July, what are you doing? You're out there grilling, you're having a picnic, you're drinking beer, that kind of thing. So you might think, well, let's look at companies that benefit from this behavior. That's going to be companies like Kraft and Heinz. It's going to be a company like PepsiCo. It's going to be a company like Tyson. It's going to be a company like Molson Coors. What I want to do, I actually want to look at AB InBev. I want to look at the relative returns of this stock and the S&P 500 and see if there's any kind of a pattern here. And I found some interesting things. So again, these are excess or relative returns. What I found is that AB InBev has its best monthly performance in June, right? So by far, this is the best. Going back 2007 through the present, the best returns for this company in June, which just happens to be the month where summer starts, and it's the month that leads right up to the 4th of July. So investors are saying, hey, we know this is going to be a great season for this company. Let's buy prior to it and then ride it out. Interestingly, then if you look at where are the worst returns, those are in October. So that's the month right after summer ends. Again, the investors are kind of saying, hey, we know this is coming. Let's get in. We reap the benefits of these revenues and we get out. Now, I would argue this is a bit of a cognitive error, behavioral bias, because we already know there's going to be that seasonal pattern. Why should we get in and out, if the market already knows that? But it kind of looks like the market isn't pricing that in to that stock in June and in October. Now, what I also did is I looked at daily returns. I wanted to, instead of looking at just months, I wanted to look at daily returns. And what I did there said, on average, again, the same time period, 2007 to 2021. So what was the average daily excess return for AB InBev? And that was -1 basis point. I said, what if I get into what about the day right before the 4th of July? Again, because we're talking about the 4th of July anomaly here. On average, the day before the 4th of July, that 1 day has an excess return of 46 basis points versus the S&P 500. And then the day after has a negative 19% abnormal return or excess return versus S&P 500. Super interesting. Didn't know what I was going to find. And I found this thing is pretty nice. Now, also just want to mention here that if you want to get some of this data came from this website, I wanted to give them some kudos out there. All that being said, that's it for today. Happy trading out there and have a great 4th of July. Thank you so much. I'm Brian Kozlowski.